For decades, U.S. Treasuries have been the ultimate symbol of financial security, a pillar of global finance that investors and governments alike have relied on. If you wanted safety, you bought U.S. bonds. Simple as that. But in 2025, that certainty is being called into question. The global economic landscape is shifting, and with it, the confidence that once surrounded America's financial dominance. A new year always brings new uncertainty, but this time, the questions being asked are much bigger. Are we witnessing the beginning of a new economic order? What does the future hold for the U.S. economy? And most importantly, is the era of U.S. Treasuries as the world's safest investment coming to an end? Adding to the turmoil, fresh tensions between the United States and China have escalated into an all-out trade war. It started with a round of tariffs, but things quickly got out of hand. The U.S. imposed a 10% tariff on all Chinese imports in early 2025. By March, that number had jumped to 20%. China retaliated fast, slapping tariffs of up to 15% on key American exports, particularly targeting agricultural products, a direct hit to U.S. farmers and businesses that rely on global trade. But it didn't stop there. Beijing also launched investigations into major U.S. corporations operating in China, sending a strong message. This isn't just a trade dispute, it's economic warfare. Global markets have responded accordingly. Investors don't like uncertainty, and right now, uncertainty is everywhere. Stocks have been on a roller coaster ride, and volatility is the only constant. But the biggest shock? A wave of bond sell-offs from some of America's closest allies. 16 countries, including Japan, Saudi Arabia, and the UK, have significantly reduced their holdings of U.S. Treasuries. This isn't just a minor adjustment, it's a state. The financial world is paying attention, and Washington is feeling the pressure. For years, U.S. bonds have been seen as a no-brainer investment. They were the bedrock of stability, backed by the biggest economy in the world. Governments, institutions, and investors held on to them because they knew no matter what happened, the U.S. would always pay its debts. But that perception is starting to crack, with America's national debt now exceeding $36 trillion. Yes, trillion. Some are starting to wonder, is this sustainable? It's not just about the debt itself. The way Washington is handling it is making investors nervous. In a move that has raised eyebrows around the world, former President Trump has floated unconventional ideas for managing the debt, from pressuring foreign governments to accept alternative financial arrangements to selling residency cards as a way to generate revenue. While some see these as bold solutions, others see them as signs of desperation. If America starts treating its debt as a problem to be negotiated rather than an obligation to be met, what does that say to the rest of the world? And that's where things get even more complicated. The bond sell-off isn't just about the numbers, it's also about geopolitics. Saudi Arabia, once one of the most dependable buyers of U.S. debt, has been pivoting toward China. This is huge. The petrodollar system, the arrangement that has kept oil sales primarily conducted in U.S. dollars for decades, is being quietly reconsidered. If Saudi Arabia and other oil-producing nations start accepting Chinese yuan for their oil sales, it could deal a serious blow to the dollar's dominance. Japan, traditionally one of the largest holders of U.S. bonds, is also making moves. Despite being one of America's closest allies, Japan has been gradually reducing its exposure to U.S. debt. Some experts say it's a simple economic decision. Japan needs liquidity for domestic investments and defense spending, but others see it as something bigger, a sign that even the most loyal economic partners are looking for alternatives. Then there's the United Kingdom. Post-Brexit, the UK has been working hard to establish itself as a global financial center independent of the European Union. But what does that mean for its relationship with the US? Some analysts believe London is diversifying its holdings, looking beyond U.S. Treasuries to strengthen its financial stability in a rapidly changing world. If that's the case, it means even America's closest allies are hedging their bets. The broader trend is clear. The world is looking for alternatives. Gold, the Chinese yuan, even cryptocurrencies. These aren't just fringe assets anymore. They're becoming real options for countries looking to reduce their dependence on the U.S. financial system. And with rising interest rates making bonds less attractive, the incentive to look elsewhere has never been stronger. Washington, of course, is downplaying the situation. The U.S. Treasury Department insists that America still has the deepest and most liquid bond market in the world. They say these fluctuations are normal and that there's no real cause for concern. But here's the thing. Markets don't run on reassurances. They run on confidence. And right now, confidence in the U.S. financial system isn't as rock solid as it used to be. This isn't to say the dollar is collapsing tomorrow. That's not how these things work. But shifts like these don't happen overnight. They build over time. If more countries start offloading U.S. debt, if the petrodollar system weakens, if China continues to push for an alternative financial order, then the landscape of global finance will look very different in the years ahead. The bond sell-off we're seeing from America's closest allies isn't happening in a vacuum. There are very specific reasons driving this shift, and they all point to one uncomfortable reality. Confidence in U.S. financial stability is being tested like never before. Some say this is just a response to short-term volatility, while others believe it's the start of a much bigger trend, one that could fundamentally change the global economic order. Let's start with one of the biggest concerns: debt. The United States has been borrowing at an unprecedented rate, and the numbers are staggering. The national debt has now surpassed $36 trillion, an amount so large that it's difficult to even comprehend. To put it in perspective, that's more than 120% of America's GDP. Every single year, the U.S. government is spending far more than it brings in, and the gap is only growing. Now, borrowing isn't necessarily a bad thing. Governments all over the world do it, and as long as there's confidence that debt will be repaid, investors are usually willing to buy bonds without too much concern. But here's where things get tricky. The way Washington is handling this debt isn't exactly reassuring. Instead of implementing long-term strategies to reduce the deficit, the U.S. is relying on short-term fixes, political brinkmanship, and in some cases, ideas that sound more like gimmicks than real solutions. One of the more controversial proposals that's been floated involves pressuring foreign governments to accept alternative financial arrangements in exchange for holding U.S. debt. Another involves selling U.S. residency cards as a way to generate revenue. These ideas might seem creative to some, but to global investors, they raise serious red flags. If the U.S. is considering such unconventional tactics, what does that say about the long-term stability of its financial system? This uncertainty is amplified by rising interest rates. Over the past year, the Federal Reserve has aggressively raised rates to combat inflation, making borrowing more expensive across the board. In theory, higher interest rates should make U.S. Treasuries more attractive because they offer a better return. But there's a catch. When interest rates go up, the value of existing bonds goes down. And for investors who already hold large amounts of U.S. debt, that's a problem. Countries that have been holding onto U.S. bonds for years are now looking at their portfolios and realizing they're losing money. When interest rates were near zero, bonds were a safe bet. But now as yields rise, older bonds are worth less, and the incentive to sell them off and move into other assets is stronger than ever. And that's exactly what we're seeing. The big question is, where is the money going instead? The answer isn't simple, but one thing is clear. Many countries are looking to diversify. Gold is making a major comeback as a reserve asset. Central banks around the world have been increasing their gold holdings at record levels, a move that signals a lack of trust in traditional financial systems. And then there's China's yuan, which has been gaining traction as an alternative to the US dollar. China has been aggressively pushing for more international transactions to be conducted in yuan, particularly when it comes to oil and trade agreements with key partners. Cryptocurrencies are also entering the equation. While still considered volatile, digital assets like Bitcoin and Ethereum are increasingly being seen as a hedge against traditional financial instability. Some nations are even experimenting with central bank digital currencies, which could further reduce reliance on the US dollar in the long run. One of the biggest players in this shift is Saudi Arabia. For decades, the kingdom has been a cornerstone of the petrodollar system, which ensures that oil transactions are conducted in US dollars. But recent moves suggest that Saudi Arabia is reconsidering its position. The country has strengthened its ties with China, signing long-term energy agreements that could eventually see oil sales conducted in yuan instead of dollars. If that happens, it would be a major blow to the dollar's dominance and could accelerate the trend of nations looking for alternative reserves. Japan, traditionally one of the largest holders of U.S. bonds, is also shifting its strategy. The Japanese government is facing its own economic challenges, including the need to fund rising defense spending and stimulate domestic growth. As a result, Japan has been gradually reducing its U.S. bond holdings and reallocating funds toward other investments. Some see this as a purely economic decision, but others believe it's also a political signal that Japan is preparing for a more multipolar financial world. And then there's the United Kingdom. Post-Brexit, the UK has been working hard to redefine its financial strategy. While London has historically been aligned with Washington on economic policy, the changing global landscape is forcing it to reconsider its position. Diversifying its holdings and exploring new financial partnerships could be a way for the UK to strengthen its economic standing without being overly reliant on the US. So, is this a coordinated effort to move away from US Treasuries, or is it just a coincidence that so many countries are making the same decision at the same time? Officially, there's no grand conspiracy. Each nation has its own economic and political reasons for reducing its US bond holdings. But when you take a step back and look at the bigger picture, the trend is undeniable. The world is shifting, and the days of unquestioned US financial dominance may be coming to an end. This brings us to a critical question. What happens if this trend continues? If more and more countries start dumping US bonds, the cost of borrowing for the U.S. government will rise. That means higher interest rates, not just for the government, but for businesses and consumers as well. Mortgages, car loans, credit cards, everything becomes more expensive. And if the U.S. struggles to attract buyers for its debt, it could lead to a financial crisis that ripples across the global economy. Of course, not everyone believes this is a serious threat. Some experts argue that the dollar is still the world's dominant reserve currency, and that no viable alternative exists to replace it. The U.S. economy remains the largest in the world, and its military and technological power continue to make it a global leader. From this perspective, the recent bond sell-offs are just a temporary reaction to market conditions rather than a sign of a fundamental shift. The shift away from U.S. Treasuries isn't just about economics, it's about geopolitics. The way global powers align financially has always been tied to political strategy, military alliances, and economic influence. What we're seeing now is more than just a few countries tweaking their investment portfolios. This is a broader realignment, one that suggests nations are not only questioning America's financial strength, but also rethinking their political and economic relationships with Washington. Take Saudi Arabia, for example. For decades, the kingdom has been one of the most reliable holders of U.S. debt. It was a key player in the petrodollar system, ensuring that oil sales remained tied to the dollar. But now something has changed. Saudi Arabia has been strengthening its ties with China, and the whispers of oil sales in yuan instead of dollars are getting louder. If that happens, it wouldn't just be a financial decision, it would be a geopolitical earthquake. The relationship between Washington and Riyadh has been strained in recent years. There have been tensions over human rights, OPEC plus production cuts, and U.S. policies in the Middle East. The Saudis have been increasingly frustrated with American foreign policy, and their growing economic ties with China and Russia suggest that they're exploring alternatives. If Saudi Arabia starts pricing oil in yuan or diversifying its reserves away from the dollar, it could set off a chain reaction across other Gulf nations and beyond. It's not just the Middle East that's rethinking its reliance on the U.S. financial system. In Asia, Japan has traditionally been one of the biggest buyers of U.S. bonds. Even as the yen weakened, Japan continued to pour money into U.S. Treasuries, seeing them as a safe and strategic asset. But now, Japan is selling. Why? The reasons are complex. On one hand, Japan is dealing with its own economic challenges, including rising defense spending and the need to stimulate growth. On the other hand, Japan is navigating a delicate regional balance. The United States has been pushing an aggressive stance in the Asia-Pacific region, strengthening alliances with countries like South Korea, Australia, and the Philippines to counter China's influence. Japan, as a key U.S. ally, is caught in the middle. It wants to maintain its strategic relationship with Washington, but it also knows that China is its largest trading partner. Reducing U.S. bond holdings may not be a direct political message, but it's certainly a sign that Japan is hedging its bets. Diversifying its reserves and limiting exposure to U.S. debt gives Tokyo more flexibility in an uncertain geopolitical environment. And then there's Europe. The United Kingdom has long been one of America's closest allies, especially in the financial sector. The special relationship between Washington and London has been a cornerstone of global finance. But since Brexit, the UK has been forced to rethink its economic strategy. With no longer being part of the EU, London is looking for ways to secure its position as a global financial hub. Part of that strategy seems to involve reducing its exposure to U.S. debt and exploring alternative investments. Some analysts argue that the UK's decision to scale back its U.S. bond holdings is purely financial. It wants to strengthen the British pound and attract more international capital. But others believe there's a bigger picture at play. Europe as a whole is starting to realize that it cannot always rely on the United States. The energy crisis triggered by the war in Ukraine, Washington's unpredictable foreign policy, and the growing divide between European interests and U.S. priorities are all pushing countries to consider financial diversification. And let's not forget China and Russia. These two nations have been working for years to establish a financial system that operates outside of U.S. influence. China has been aggressively promoting the yuan as an alternative reserve currency, signing bilateral trade agreements that bypass the dollar, and increasing its gold reserves. Russia, cut off from much of the Western financial system due to sanctions, has been accelerating efforts to de-dollarize its economy. The BRICS nations, Brazil, Russia, India, China, and South Africa, have also been pushing for alternative financial structures that reduce dependence on the U.S. This global shift raises an important question. Is the world moving toward a multipolar financial system? For decades, the U.S. dollar has been the undisputed king of global finance. Nearly all international trade, major transactions, and reserve holdings were dollar-based. But as more countries start selling U.S. bonds, accumulating gold, and exploring alternative currencies, we're seeing the early stages of a financial world that isn't entirely centered around the dollar. Of course, Washington isn't sitting idly by. The U.S. Treasury Department and the Federal Reserve have been trying to reassure markets, insisting that the U.S. remains the safest investment in the world. They argue that bond fluctuations are normal and that America's financial position is still rock solid. But confidence isn't just about data, it's about perception. And right now, the perception is shifting. This wave of bond sales feels like a slow-moving snowball. It starts small, but if enough countries start selling, it could gain momentum and turn into something much bigger. If the U.S. struggles to attract buyers for its debt, interest rates will rise even further. That would make borrowing more expensive, not just for the government, but for businesses and consumers as well. Mortgages, car loans, credit card debt, it would all become costlier. And if confidence in U.S. bonds continues to erode, we could see a major economic shakeup. Developing nations that rely on U.S. dollars for trade and financing would be hit the hardest. Many of these countries already struggle with debt, and if the cost of borrowing in dollars rises, it could trigger financial crises in multiple regions. Countries that are dependent on dollar-based trade could find themselves facing higher inflation, currency instability, and economic slowdowns. But here's the thing. Not everyone thinks this is a disaster waiting to happen. Some economists believe that despite these shifts, the dollar will remain the dominant global currency for the foreseeable future. They argue that no other currency, not the yuan, not gold, not crypto, has the same level of liquidity, trust, and stability as the US dollar. They also point out that the US economy is still the largest in the world, with unparalleled military, technological, and financial power. So where does all of this lead? Are we looking at a slow and steady shift away from US financial dominance, or is this just another round of market adjustments that will eventually stabilize? The answer isn't straightforward, but what we do know is that things are changing, and the financial landscape of the future may not look the same as the one we've been used to for decades. Right now, the biggest question hanging over global markets is whether the US dollar will remain the dominant force it has been for the last century. Even with rising debt, political instability, and the growing trend of allies diversifying their reserves, the dollar still has something no other currency can match: trust. For all the challenges the US faces, it is still home to the world's most liquid financial markets. Its economy is still the largest, and its military presence ensures a level of geopolitical influence that most other nations simply can't rival. That alone keeps the dollar in a position of strength. But trust isn't invincible. The growing debt burden, the frequent political battles over raising the debt ceiling, and the perception that Washington is becoming increasingly unpredictable all contribute to a growing sense of caution among investors and governments worldwide. The US has always argued that its debt is safe because it always pays it back. But what happens when that safety starts to look shaky? The near-government shutdowns, the back-and-forth debt ceiling debates, and the inability to reach long-term financial agreements have all made investors nervous. Every time a political crisis in Washington brings the country to the brink of default, the world watches, and some countries take action. That's exactly why so many nations are hedging their bets. Japan, Saudi Arabia, the UK, and other allies aren't necessarily turning against the US, but they're preparing for a world where they might not want to rely so heavily on one financial system. And it's not just about money, it's about strategy. If holding too many US bonds exposes them to risk, then diversifying their reserves isn't just a financial decision, it's a national security decision. This leads us to the bigger question: what happens if this trend accelerates? If more countries keep selling off their US Treasury holdings, Washington will have to raise interest rates even further to attract buyers. That makes borrowing more expensive, which puts more pressure on businesses and consumers. Inflation is already a major concern, and higher interest rates could make it even harder for people to afford homes, cars, or business loans. And then there's the stock market. Investors don't just look at US Treasuries, they look at the broader financial picture. If confidence in the US economy weakens, stock prices could take a hit. And if major international investors start pulling money out of American assets, it could lead to a wave of volatility that affects global markets. For developing nations, the impact could be even worse. Many countries rely on dollar-based loans for infrastructure projects, trade deals, and economic stability. If the cost of borrowing in dollars goes up, it could push already struggling economies into crisis. We've seen this happen before. Countries that are too reliant on dollar-based financing can suddenly find themselves in deep trouble if interest rates spike or if the value of their own currency drops against the dollar. If US bond sales continue and the cost of borrowing rises globally, some of the world's weaker economies could be facing an economic shock. But let's not forget, there's still no real replacement for the US dollar. Even though China is pushing the yuan, even though countries are stockpiling gold, and even though cryptocurrencies are gaining traction, the fact remains that no other financial system offers the same level of security, liquidity, and global acceptance as the US dollar. The euro has its own political and economic problems. The yuan is tightly controlled by the Chinese government, and cryptocurrencies are still too volatile for most governments to use as a serious alternative. That's why some experts argue that while the US may be losing a little bit of its edge, it's nowhere near losing its global dominance. The Federal Reserve still has the tools to stabilize markets. Washington still has the ability to negotiate financial agreements with its allies. And most importantly, when crises hit, people still turn to the US for stability. When banks collapse in Europe, investors buy US bonds. When emerging markets struggle, they look to the US for loans and trade deals. Even with all of its problems, the US remains the central player in the global financial system. But that doesn't mean the US can afford to be complacent. The world is clearly looking for alternatives, and the longer Washington ignores this trend, the more likely it is that the shift away from the dollar will continue. If the US wants to maintain its financial dominance, it will need to make some big moves, reducing its debt, stabilizing its economy, and rebuilding confidence in its political system. The bond sell-off we're seeing now might just be a warning sign of what's to come if those issues aren't addressed. So what does all of this mean for the future? Will the US dollar remain the world's dominant currency, or are we witnessing the early signs of a global financial realignment? Could a new system emerge where the dollar still plays a role but isn't the undisputed king? And if that happens, what does it mean for businesses, investors, and everyday people? The truth is, nobody knows for sure. What we do know is that the financial world is evolving. Countries are making moves to protect themselves from instability, and that means the dominance of US bonds and the dollar isn't as unshakable as it once was. Whether this is just a temporary shift or the beginning of a major transformation remains to be seen. We want to hear from you. Do you think the US is losing its financial grip on the world, or is this just another cycle in the global economy? Will the dollar remain dominant, or is the world ready for a new financial order?